Hey everyone, welcome back. I'm Shelly, and today we're diving into some thought-provoking insights from the founder of Oka Tree Capital, Howard Marks. If you've ever wondered about market bubbles, investment psychology, and what really drives stock prices, you're in for a treat. Grab your notebooks because we're breaking down key points that could reshape how you think about investing. So let's get started. The nature of bubbles. First up, let's talk about the bubbles. Marx reflects on his famous 25-year-old memo titled Bubble.com, where he highlighted irrational behaviors in tech and internet stocks. He notes that bubbles are not just about skyrocketing prices, they're often driven by intense psychological state. When everyone around you is buying, it's really easy to feel left out and jump on the bandwagon. This leads to a fear of missing out, that's FOMO mentality, where the belief that no price is too high takes hold. Marx emphasizes that recognizing this mindset is crucial for identifying bubbles before they burst. Psychological triggers. The psychology behind bubbles is fascinating. People often engage in confirmation bias, seeking out information that supports their bullish outlook while dismissing any warning signs. This kind of thinking can create a feedback loop where rising prices lead to more buying, reinforcing the belief that prices will continue to rise indefinitely. As an investor, it's essential to be aware of these psychological traps. The key is to remain objective and not let emotion dictate your investment decisions. Ask yourself, are you buying because you believe in the fundamentals or because everyone else is? Historical context. Looking back, Marx points out that investors have lived through multiple bubbles, including the TMT bubble in the late 90s and the real estate bubble in the mid-2000s. Each time, investors faced significant losses and when the bubbles bursts. So I'm going to talk about some of my personal perspectives. Reflecting on my own experiences, I've seen how quickly sentiment can shift. During the TMT bubble, many investors thought they were riding the wave of innovation. But when the bubble popped, the fallout was devastating. It's a stark reminder that market sentiment can change overnight, and what seems like surefire investment can quickly become a liability. This brings out to the importance of understanding the psychological dynamics of investing. Marx believes that the true danger lies in the collective mindset of investors, not just the market fundamentals. When everyone believes in the perpetual growth, it can lead to extreme overvaluation. The current market landscape. Fast forward to today, and we see similar patterns emerging. Marx discusses the 7 giants of the S&P 500 companies like Apple, Microsoft, and Nvidia that dominate the market and contribute to a significant portion of its gains. While these companies are performing well, their valuations are at unprecedented highs, raising questions about whether we are entering another bubble. So let's talk about the market valuation. Marx highlights that the top 7 companies now account for about 32 to 33% of the S&P market cap, double that it was 5 years ago. This concentration of wealth is concerning. Historically, such dominance has often preceded market corrections. So, as an investor, I urge you to look beyond the headlines. Just because a company is performing well doesn't mean its stock price is justified. Take the time to analyze fundamentals and consider whether current valuations are sustainable. So, one of the key takeaways from Marx's insights is a relation between price and value. He emphasized that the investing is not just about what you buy, but how much you pay for it. Good investments come down to purchasing valuable assets at reasonable prices. In my journey as an investor, I've learned that the hard way that good companies can be bad investments if you overpay. I remember a time when I bought into a tech stock that everyone was raving about. The fundamentals was solid, but I entered at a peak price. When the market corrected, my investment tanked. This taught me the critical lesson that is always assess the price relative to value. Marx reminds us that no asset is too good to be overpriced, and no asset is too bad to have a bargain opportunity. This is where caution is critical. Investors often overlook risk when they get caught up in the excitement of new technology or trends. So let's looking ahead. What does this mean for you as an investor? Marx suggests adopting a more skeptical mindset. It's essential to question the prevailing narratives and not get swept up in the hypes. As we look ahead, it's vital to analyze the fundamentals behind investments and not just to follow the crowd. Marx warns that high valuations today could lead to disappointing returns in the future. With the current enthusiasm for AI and tech stocks, it's crucial to remain grounded. Just because a trend is popular doesn't guarantee it's a sound investment. So look ahead, I think it's vital to keep a diversified portfolio. During the times of uncertainty, diversification acts as a safety net. It allows you to weather market volatility and take advantage of opportunities as they arise. So let's conclude this text. In conclusion, Howard Marks provides valuable insights that everyone investor should consider. Bubbles are often filled by collective psychology, and understanding this can help you navigate the market more effectively. Remember to focus on valuation and approach investments with a healthy dose of skepticism. Okay, if you found this analysis helpful, please give it a thumbs up and share your thoughts in the comments. Do you think we are headed for another bubble? Thanks for watching, and I'll see you in next video. Bye!